How you guys doing? This playlist is going to be using this Robinhood account and just doing the wheel strategy. I'm going to make videos just showing what basically what covered calls and cash secured puts I am opening and closing and how I'm doing it. I'm going to try and grow this account just using the wheel strategy. The wheel strategy, quick summary, is selling cash secured puts and then selling covered calls. So cash secured put, if you don't know, is if you have cash in your account called buying power in Robinhood, you can sell a put. So I have this one here, and I'll kind of just show you how I set this one up. If we go to DraftKings, it's trading for $40 right now. So if I wanted to sell a put on DraftKings, it'd be sell put, and the expiration for Friday, and I want to sell a put for $37 strike price. Basically, I need the money to buy 100 shares at this strike price. So I would sell one contract. I'm just selling one. This is the spread between the bid and the ask. Market's closed right now, but basically I would need $3,700, because if DraftKings goes down to $37 a share, then I could be exercised, and exercise basically would mean this contract would be exercised. I would no longer own the contract, and I would then own 100 shares at $37, no matter the cost of DraftKings. So if DraftKings goes down to $10, that doesn't matter. I would still be forced to buy 100 shares at $37. If DraftKings stays up here, then this contract will expire worthless. It'll expire worthless on the expiration date. So that's if I don't touch anything. So basically, for me to open up this trade, this position, this put contract, this put option contract, for me to sell this, the person buying it will be paying me $75 for that position. So if you look here, if you go to buying, okay, so if you were saying I want to buy a DraftKings put because I think DraftKings is going down, it's going to cost me $78 for this. That $78 or $75 is going to go to someone that's selling it, which would be me in this case. So then I would receive that credit, and I would have a contract open. My buying power would show $3,700 less, since Robinhood has to hold that money for in case DraftKings goes down and I get exercised. Because then if I get exercised, I will be forced to buy DraftKings at $37 a share, and I'll have to buy 100 shares of it. However, if it stays above it, by expiration, then this contract loses value and it'll become worthless. So that's the simple selling put part of it. Now, if it does go down, I get exercised. Say it goes down to $30, and then I get exercised. Then I will own 100 shares of DraftKings at a $37 strike price. So then my shares on that would be, I would have lost money in that way. However, once I own 100 shares of it, what I can do then is I can sell a covered call. So say if I own 100 shares of DraftKings and my strike price is $30, I would go to sell a call, and this is if I own 100 shares. Say it's expiring November 13th, that's this Friday. And then I could sell a call for higher than the strike price that I owned it. So if I own it at $30 and say it's trading at 25, if I went to sell a call, I could sell it for 30, I could sell it for 31. Given these premiums will be different, so for better reference, say it's $48 is where I own it at. So then I would go and I'd sell this covered call. And then to sell the covered call, they would basically hold my 100 shares as collateral, and in return I receive a credit. I receive the $30 credit. And then if DraftKings stays below this $48, this contract expires worthless, and I still have 100 shares, and I keep the credit either way for opening up this position. So basically you go back and forth. There's many different ways to do it. Once a contract's open, you can close it before expiration. There's a lot of different ways to do it, but that's basically all I'm going to do with this account. We're not going to hold shares unless we get exercised, and when we do, we're just going to do covered calls. I'm trying to pick stocks that I wouldn't mind having in the long-term account here. ones I think that are good and will be around, but also ones that aren't going to be not give us any premium, because some stocks just don't move, and so you don't really get any premium when you sell a cash secured put or a covered call. So that's the wheel basically, and I'll show you what we have here is this is flat, and this is when we started doing it. Basically these numbers, I mean, the dips and all that doesn't matter a whole bunch with this. It really just depends on, at the date of expiration, what's the strike price on that stock. So it'll dip, it'll go up, it'll go down. So if you look at DraftKings right now, when I opened this, it was higher. I opened this contract. I sold a put on this contract yesterday. It was up here. So that put contract actually gained value, which is not what you want when you're selling it. So if I sold it today, the same contract, I would have gotten, or the same two contracts, I would have gotten $34 more. So that's why my total return on right now is $34 less. However, this number doesn't matter, like I said, a whole lot. Really what I'm looking at is DraftKings by Friday, yep, the 13th, Friday the 13th, oh boy, is above $36. So 35, I thought 36 was a good strike price because I thought this was a nice price to own it at, right about here. So as long as it stays above here, that number doesn't matter to me by expiration, whether it goes up or down, or, you know, doesn't matter. Now, if DraftKings goes up really quickly, say tomorrow it runs up 5-10%, this contract will become less and less valuable, and potentially I'll close it out before the expiration, just because I want to get my collateral back to open up another one. So basically, yeah, if DraftKings goes up 5-10% tomorrow, this will lose value, and then I can buy to close. I have two of them. I'd buy to close, and this would be the price I'd pay to buy it back. See, right now the price I'd pay to buy it back will be more than the credit that I received to sell it. So when this contract loses value, you can see on here, so right here is real valuable, 98 cents. This was earlier this morning, and then it's lost value today. And as time goes on, it will lose value naturally unless it's going against you. So if it keeps going down, the time decay is not really going to matter. But if it stays flat or goes up, the contract is going to lose value with time because of that expiration. It's a ticking clock. So basically, if DraftKings shot up to $45 strike price, then this contract would be less valuable. So I could buy it back, say for $20 a contract, and then I'd only pay $40. So then the money I would have made on this position would be the difference between $72 and $40. So that's kind of closing it out early. Typically, I wouldn't close it out that early. I do have an order. I usually put an order in just so I can leave it alone, but I'll put an order in for just like that, and I'll do that right now. Let's see if I can do that on here. So they trade in increments of 5-cent increments, and yeah, depending on how much credit I receive, sometimes I won't do that. Maybe I won't do that on this one because that'll be $10 of that profit, but I'll show you. I did that on RKT, and this just had earnings, so we'll see. I'm not sure. Hopefully it kind of goes up. It kind of came down after hours, but yeah, right now this contract is worth less than when I opened it. So when I sold the contract, it was worth 50 cents instead of what it's worth now, which is 37 cents. If I want to close it, I'd do buy to close, and then I would put in that. I only have one contract though. There, and then I would change the expiration until canceled. So basically, I don't have to mess with this at all, regardless. So if RKT goes up, Rocket Companies, if it goes up, and I'm not watching it, this will automatically close once this contract's only worth 1 cent. And you can see I have that placed right here. So I'll leave that open, and then sometimes, I won't be looking at it, and it'll close it out, and then I have my collateral back, which you can see here. It already has pending shares. That would release this is $3,600, or no, this is $1,800, $1,850. collateral would be released once I close that back out. And then I've also got an Under Armour. This one doesn't have a whole lot of premium, kind of a slow mover. So, but this one actually has a further expiration. So the 20th, with longer expirations, you're going to get more premium. But you have to wait longer for it to move. The time is not going to really fluctuate the contract price as much. So this one's already up 60%. I could close it out now and take a little profit. I'll probably wait. There's not a whole lot of collateral. It's tying up. And for Under Armour to go down to $11.50 is pretty unlikely. It's at 13.3. Let's see. I actually use Webull for all my charts, so yeah. I mean, this would be a nice price to own it at, I think. So if it goes down here, then we'll own the shares. But I do have an order. See, I have an order out to close this. Oh no, this is in increments of 5 also, so I won't do it on this one. But that's basically it. So this $10,000, all of that $10,000 right now is being held in collateral in these 4 contracts. So it's basically like owning the shares. However, if the stock doesn't go down enough, you never own the shares. You just collected premium to hold these contracts. That's probably the simplest way to put it when you're selling puts. It's basically the same as owning the shares. However, you never actually buy the shares unless if the share price goes down to your strike price at expiration. So even if it goes down to, DraftKings could go down to $30 tomorrow. Sometimes you get extra. So that's a whole other thing. You could still get exercised. And that happens if there's an ex-dividend date or there's other factors. But typically, you won't get exercised unless someone really wants to buy it. But it could go down to $30 tomorrow, and that won't matter. As long as it's up above $36 on Friday, will then this thing be exercised for the most part. You do also have to keep in mind that Robinhood does exercise up to 2 hours before the market closes. So I don't know, actually, no, that wouldn't. Yeah, I guess that could apply to selling puts, but that's basically it. So we're gonna do the wheel on this. We're gonna see how it goes. So far we're up. I mean, this is a bad representation because this thing just fluctuates. Really, you have to look at it on Friday. So I'll probably make another video on Friday to show where we're at. Because this, if I'm right about these will expire with full value, and then that'll be $72 on this one. Rocket will have $50, so that'll be, $120 something, and instead of 47, so that'll show a better representation. But at this point, yeah, we're up 0.5% in the last, really been maybe a week. October 30th, yeah, it's been about a week. So we'll see how it goes. This is a slow. I mean, you can make it fast and make it more sketchy, more aggressive. But the way I'm going to do it's going to be pretty slow, pretty safe. There's also ways you can do it just using the Greeks, which I'm not really going to get into. I don't know a whole lot about the different strategies with this, but I've seen some people that, excuse me, that just sell based on the delta. COVID got me. I'm just kidding. Delta 0.26. So I've seen one strategy to sell puts at the delta of 0.2 and to just not even look at anything else. Just sell it at 0.2, and then if you get exercised, sell a covered call with a delta at 0.3. I'm not going to go into the Greeks, but where are we? There's 0.6. The 0.3 would actually be down here. That's weird. But for me, I'm going to look at the charts and kind of decide if I think it's close to a bottom or it's low and there's premium on it, then I'll sell it, and if it's a good stock to own, and if my strike price can be low enough to where it would be comfortable for me to own it. But that's this account. Make sure to subscribe, hit the notification, sub up, like up, comment down, make money, happy money, so stick around, and we will see you probably on Friday. We'll look at how these contracts played out. Thanks, later.